Just yesterday, SoFi's chief financial officer dropped a major hint for all retail shareholders. The fact that SoFi has been working with the top 5 US financial institution. And in this video, I'm going to be talking about that, along with a few other key takeaways from the recent fireside chat featuring SoFi's chief financial officer, Chris Lapointe. Now, this happened as part of a longer 1-hour fireside chat hosted by UBS on Monday, and I think perhaps this was one of the best fireside chats that we've seen from Chris Lapointe in recent times, because the questions asked by the UBS hosts were pointed, they were detailed, and this is unlike many other firesides where basically the SoFi team has to regurgitate the main value proposition of the company, the main growth story, which is very common to much of the retail community. However, in this event, it seemed as though we were able to dive a layer deeper because of the quality of questions. Now, I covered this event live in my channel yesterday, giving some raw thoughts in the moment, but since that time have had the opportunity to go back and talk through some of the finer points that I may have missed. And so I've basically combed through this interview just so that you don't have to talk about some of the main notes. Now, before I get started, if you are new to the channel, I talk about SoFi news on a weekly basis. So if you follow SoFi and you enjoy this video, share it with other people and also subscribe to the channel for more. Let's talk first with regards to the outlook and the growth strategy as highlighted by Chris Lapointe. He mentioned that 2024 is going to be a transitional year for SoFi with significant growth expected in the tech platform and the financial services platforms respectively. Because as we know, lending, which was the majority of their revenue in 2023, is essentially going to be flat this year, with growth primarily driven from financial services, which is expected to grow 75% this year, and the tech platform, which is expected to grow 20% this year. And I've been on the record multiple times saying that I don't think lending is going to be flat. That's a conservative approach that the company is taking. But the idea is for the technology platform along with the financial services platform combined to comprise about 50% of the total revenue for this year, 2024. In 2023, both of these segments combined were about 38% of revenue. So lending still made up the majority of the revenue. Interestingly, with regards to the tech platform, Chris Lapointe highlighted a 20% growth guidance for this year, but later in the talk mentioned a 25% compound annual growth rate for the technology platform for the next 3 years, meaning that if you read between the lines, what he's saying is that the technology platform growth is going to accelerate after 2024. Similarly, with the lending business, he did highlight that the company was taking a conservative approach in 2024 with regards to the macro uncertainty, but he also mentioned the election as well, and he basically said that in 25 and in 26, they're going to be accelerating in lending as well. So I would expect the lending growth to be continuing. It's probably going to take somewhat of a pause because 2023 was such a mega year for lending, particularly with personal loans. But in 2025 and 2026, that's going to also re-accelerate. He reiterated the outlook over the next 3 years that Anthony Noto shared in the last earnings call, basically saying that they're going to have compound growth of 20 to 25% across all of their businesses, with financial services, which is expected to grow by 50%. He also touched on the margins, basically saying that, they expect to exit 2024 with roughly 30% EBITDA margins, saying that, quote, "We've done a really nice job of dropping more to the bottom line over the course of the last several quarters. Notable improvements in sales and marketing efficiencies, particularly brand awareness, cross-buy initiatives also contributed to this as well." So from a margin perspective, obviously profitability is something that they're expecting to have going forward and accelerating even the rate with which they are profitable through these different levers that they can pull. Moving now to the loan origination trends, this was an interesting conversation because the host basically pushed them around the macro uncertainty, saying that if we do have a better macro, are these forecasts going to change with regards to the guidance that they're expecting? To which Chris Lapointe basically said that they're taking a conservative approach and that they are prepared to allocate capital nimbly based on the changing market conditions. He mentioned that personal loan originations would be flat to down, student loan refinancing growing modestly, and home loans being correlated to rates. Further to this, he said that they anticipate relatively modest growth in the balance sheet with a focus on leveraging member deposits to displace higher cost funding. They talked about the bank charter and some of the benefits that the bank charter provides, particularly with regards to lower cost of funding. And he continued a little bit further down, highlighting their goal, which is to fund more than 65% of their loans through deposit. And they discussed a little bit the net interest margins, which remain healthy at above 5%, which were driven by factors like deposit growth and loan pricing in general. In terms of credit quality, Chris Lapointe mentioned that to return to pre-pandemic levels with the losses around 7 to 8% life of loan by early to mid 2024, and that they're taking proactive measures to manage credit risk, including identifying and removing underperforming credits from the system, which is obviously what you want to see. You want to see them optimizing further to basically maximize what works and cut what doesn't work. He touched on some of the contributing factors with regards to direct deposits of over 50% of newly funded accounts setting up direct deposit by day 30. This is a metric that they continuously track and they talk about every earnings release. Chris Lapointe highlighted factors such as improved brand awareness, product differentiation, and among industry-leading APY rates, they have one of the highest APY rates for their members, in addition to the $2 million FDIC insurance, which he said they implemented days after the Silicon Valley bank collapsed, essentially to build trust and loyalty with their customers, leading to further growth in their deposits. Now, I wanted to focus the majority of this video on the technology platform because one of the aspects that I really enjoyed in this talk was a higher importance on the tech platform specifically. I suspect this is going to be a trend in 2024 as the technology platform will essentially contribute to more consistent revenue for SoFi's revenue mix going forward. We've talked about that 50-50 split, and that 50-50 split was reiterated again in this talk, right? 50% of the revenue from lending, and then the remaining 50% from a split between financial services and the technology platform. Lapointe highlighted that Galileo has seen significant growth in end customers and customer accounts, and while he did not name specific customers, the interviewer specifically asked him to name drop. He didn't disclose any, but he did drop what I think is the most important nugget in this entire fireside chat, the fact that they had completed a proof of concept with a top 5 US bank. Previously, the SoFi leadership team had mentioned terms like a top US bank or a top 10 US bank, but never really a top 5 US bank. And so what I did was I pulled a list of the top 5 banks in the US to give us an idea, and the choices here are fairly clear. The top 5 banks in the US are JP Morgan, Wells Fargo, Bank of America, Citigroup, and US Bank. So basically the tagline here is SoFi has completed a proof of concept with one of these banks. And the other thing to note here is that this statement was made in the past tense. In other words, suggesting that the proof of concept had already been completed and that it was no longer underway. And this begs the question of whether this proof of concept was successful, in which case we would see the massive migrations of accounts onto Galileo. And if it was successful, when are we going to see this massive migration of accounts? What's that timeline look like? Well, Chris Lapointe also mentioned that these financial institutions are increasingly turning to SoFi for core migration and modernization of their tech stacks. He mentioned that this shift is driven by the need to replace their fragmented legacy systems with extensible and customizable solutions. So basically saying that, SoFi solutions are plug and play, they're cloud-based, they're scalable, and they appeal to banks looking to streamline their operations and offer more comprehensive services beyond just debit processing. And this fact alone makes me very confident that the proof of concept with this major 5 bank was in fact successful because, as I mentioned previously, SoFi's technology platform has a strong competitive moat. It's not in a perfect competition where there's many other companies vying for the same clientele. They actually have built a moat as a result of their acquisition of Technisys, and as a result of this, their value proposition is very unique to these legacy financial institutions. They're offering an escape route from this old way of working that the banks are currently in to a new, seamless, plug-and-play out-of-the-box, cloud-based, scalable solution, which is what Galileo offers. And this is not just US banks, right? Chris Lapointe touched on the international expansion and the growth potential of the technology platform, saying, quote, "We're in the process of expanding to 17 different countries around North America and Canada, as well as South and Central America." And he mentioned that this is as a result of them building catered products for these different markets, but these are different markets that they are thinking about as well. And you got to keep in mind as well that Technisys comes from a Latin American background. There was a Latin American company, a lot of the clientele is in Latin America, and Galileo has that North American clientele. And so now you see the cross-pollination of the clientele across the combined entity of Technisys and Galileo. So what we're seeing currently with the technology platform is not only an expansion of customers, but also an expansion of geographies and also an expansion of different product offerings. Chris Lapointe mentioned in the fireside chat that historically they had gone after small fintechs and neobanks, and now they had shifted their entire strategy to focus on large financial institutions and banks because this demographic had a large installed base of customers. And on this note, when asked, he also highlighted a focus on offering tailored solutions to meet specific customer needs. So when you think about Galileo, many people wonder immediately what banks they're working with or what financial institutions they're working with. And the important thing to highlight is that Galileo is also catering to different industry verticals as well, and all of these product offerings are tailored. So they're tailoring product offerings to different verticals and to different countries in their geographic expansion plan. So when you think about that, the total addressable market for Galileo is so much bigger than just financial legacy institutions, which makes the bull case so much more tantalizing, right? And further to this, Chris Lapointe mentioned that today, the vast majority of the deals won by the technology platform include a formal RFP process whereby SoFi competes against legacy, incumbent, and homegrown solutions, and where Galileo wins is in this cloud-based infrastructure and product offering. And the reason why they win these deals is because Galileo is way more comprehensive of a product offering than whatever these traditional financial institutions have built in-house or can possibly provide. And with regards to this growth rate, Chris Lapointe highlighted that this is going to be about 25% compound annual growth rate over the course of the next 3 years. That's going to be driven by continued momentum of existing customers as well as new customers that we are starting to sign up. So I think the insights on the technology platform are definitely the ones that we should be latching onto and that analysts across the board should be latching onto, because that is the highest level of ambiguity around the SoFi projections from traditional analysts, Wall Street analysts. They don't understand the technology platform. But Chris Lapointe very easily lays out a roadmap for the expansion of the technology platform and how that might look in the future and what exactly it does provide in terms of a key value proposition versus these legacy players. Overall, I think this was one of the best fireside chats we've had. Chris Lapointe sounded very confident throughout the chat. The quality of the questions were above and beyond what we've come to expect from analysts on earnings calls. The commentary supported much of the commentary that we've got on the latest earnings call with regards to an increased focus in the financial services and the technology platforms as a whole, their expansion respectively over the next several years, as well as a focus over the compound annual growth rate through 2026. I enjoyed that a big focus of this chat was with regards to the tech platform, because that's something we don't hear too much about. I think if analysts had a better understanding of the tech platform, they could better model this side of the business into their projections, which would obviously lead to a more favorable hybrid valuation, which is what we've been talking about on the SoFi Weekly podcast for quite some time. And of course, I think the biggest headline is the fact that SoFi had completed a proof of concept with one of the top 5 US banks. And even though he didn't disclose the name, just saying this alone narrows down the list. I mean, later on Monday, I made a poll to see what the community thought the secret bank was, and the outstanding winner of that poll was Citigroup, with some followers even highlighting the fact that Technisys has previously had connections to Citigroup and using that as a reason to justify why Citigroup was the most feasible option. I think also it's important that if it was a top 3 bank, he would have just said a top 3 bank. By saying a top 5 bank, in my mind, what that said is, take your pick between bank number 4 and bank number 5. Either way, any of the banks on this list, I think, would be very compelling for anybody watching the SoFi growth story and adding further validity to the SoFi growth story, because all of a sudden now you have this company which is profitable, this company which is the official bank of the NBA, this company which has their name on an NFL stadium and is working with one of the top 5 banks in the US. That's a serious contender. That's a company that you increasingly have to pay more and more attention to. It's not just, a SPAC that is unprofitable, that might not make it, and doesn't even have a tech platform. Like, that's not factored into the equation. So I think that SoFi is getting more serious in terms of how they're being seen by the market. And this goes along with what I've been saying with regards to institutional ownership rising and forming that solid base around SoFi. So I think that, Lapointe said 24 was a transitional year for the company. And I do believe that the underlying business is going to have a transitional year from a revenue mix perspective. Yes, but I also believe that from a stock perspective, it's also going to be a transitional year because it's going to be the year that SoFi is ready for that prime time. I've said that time and again. And so everything that we've been hearing really validates that even more. I think, of course, the main implication with regards to this proof of concept, now that it is complete, is again, when will these accounts be moving over and what that translates to in terms of Galileo revenue. Time will tell. For right now, this is the Fundamentals Investing Podcast. Thank you so much for listening.